been, he would have got an insurance cover for the bringing the mango by carrying it in the truck, insurance cover. At least out of 20,000, he might have received a claim of say 15,000 or 18,000 or whatever. His capital, entire capital would not have been lost. He could have saved at least 80 to 90% of his capital. So that is what the job of financial institution, that something has to be managed so that you do not lose your entire capital. And that management is risk management. Risk has to be managed. You have to do something in between to save it. Risk cannot be eliminated. Once you have taken or enter into the business or transaction, you cannot eliminate the risk. You have to manage the risk. That is the basic purpose of risk management. Okay. So, as you understand, to save from bankruptcy, the loss potential, or we can call this a maximum loss. These are the maximum loss. Maximum loss of the business to be controlled. So, our risk needs to be managed. These loss potential are the cost of the business. Loss potential of a business is correlated to the risk in the business, which has to be managed efficiently. That is the fundamental rule of risk management in any kind of financial institution. Okay. Now, risk management definition. Risk management is the process of assessing the actual or potential dangers of a particular situation. Or we can replace the word dangers with a loss. So risk management is the process of assessing or estimating the actual loss or maximum potential loss that may happen in your business for a particular situation. So it is, as I told you, for each transaction, we have to assess the loss in the bank. And already we know that risk that need to be managed is to control the losses in such a way that it would not wipe out or erase the entire capital which have been employed, and we can avoid the bankruptcy.
Excuse me, sir.
Yes.
So once you have said when risk is more, capital is also more, but it depends on the investor, isn't it? Like if he thinks like there is more risk, I will invest less. Then
okay.
Risk more, capital more, risk less,
okay.
capital less.
Okay. So you are suppose investor bank, your bank. Which bank you are at, working?
I'm from Canara Bank.
Canara Bank. Okay, fine. So now think that Canara Bank is the investor. Canara Bank invests the fund of the depositor into way by loan and investment. Now Canara Bank always thinks that I will be avoiding high risk, I will go for low risk. So what will happen? Low risk leads
low
to
risk, low return.
No, low risk.
Low returns.
Low returns. Low return.
Low return. So can you compete with other bank? Is
No,
Canara
sir.
Bank doing that? Is Canara Bank? Canara Bank is now a very big bank. After SBI, Canara Bank may be the second or third largest bank. So can you survive in this competitive world with a low return? Your position might be now 2 or 3 in the market. So if you consider about that, you will come down to 14 or 15. So if the profit is not there, Canara Bank management will tell that I cannot give you CIB increment for the next year. I will not give you this welfare facility given to the staff. I will not give such perks and newspaper allowances, petrol allowances I'm giving, I will curtail because I'm not having much return. Is it favorable?
No, sir.
So basically, when you are talking about investor, for a single investor like individual investor like me or you, we can think of that. There are certain investors who are very traditional and they do not want to take the risk. They may go for this low risk. But business, if you are doing so, then think about the return. You will not get the return. So you have to think in that way. So we are thinking about the investment of a bank, not an individual. Now I'm
Okay, sir.
clear? Okay.
Yes, sir. Yes, sir. Yes, sir.
Okay. So here, this loss potential are the cost of business. So that has to be assessed because controlling the level of risk. One thing is that you have to control the level of risk. So according to the size of the, we are talking about the bank, size of the bank. According to size of bank, the capacity to control, capacity to manage or control the risk also will differ. Because suppose a small bank like small, a small bank like say any small finance bank. You take in case of AU Small Finance Bank or Ujjivan Small Finance Bank, they are very small bank. And there might be a very big bank like SBI. Because size of business, size of branches, network, everything is big for SBI, whereas the small finance bank are very small in nature. As far as turnover is concerned, their business is concerned, number of branches can be very slow. So according to the size of the bank, their capacity to manage the risk or control the risk will be totally different. So, in case of risk management, controlling the level of risk will depend on the organization's capacity to bear the risk. So, that is the essence of risk management. It is not always that risk management is a single type of policy which can be followed by each and every bank uniformly. No. Risk management has got its limitation. So, smaller bank, according to their capacity, they can bear the risk according to that level. Whereas bigger banks like SBI, Canara Bank, HDFC Bank, ICICI Bank, they can manage to prevent bigger risk. They can take bigger risk. But smaller bank cannot give. So measures of these losses or potential dangers is very critical and it can help determining the adequate amount of capital which is required to prevent that loss. Okay, so this is what the risk management tells us. So measuring the loss potential is critical as it helps to arrive at how much capital is required for the business or for the transaction. So you have to know what is the requirement. And we know this is the cost of business because that cost has to be appropriated with the return so that we can arrive at the final RAROC that we have discussed. Now, for this, doing this risk management, Prema, before that, I'll just explain one more thing. We have to know two things about risk management because in risk management, everything we are considering that there is uncertainty. Risk is totally an uncertain term. It might happen, it might not happen. So risk, we can say it is a game of chance. So we have to know about two terms. So always in risk management, the deciding factor of loss, to assess the loss, we have to depend on chance. So that is called probability. Probability. There is always a probability that this might happen or this might not happen. So we can say that probability, suppose probability level is, say, we can say 80% is the probability level. That means what? Out of 100 times, out of 100, 80 times it might happen. It may happen. Whatever probability you are taking, it may happen. And 20% time, it may not happen. That is a probability. Next term you should understand, that is called impact. Impact is when it is happening. So we are taking into probabilities positive thing that when it is going to happen. So at that moment, if it happens, then what is the quantum of loss? Quantum of loss. Because if it is not going to happen, then we are not taking into consideration, because there will not be any loss. So when it is going to happen, what will be the loss? That can be taken as impact. Okay. Say, suppose this probability impact, we give it a percentage, or we can say we can give a score rating. Say we can calculate this probability and impact with a score of 0 to 10, suppose. 0 is the least and 10 is the highest. Say 10 is the 100 and 0 is a 0. So according to that, we can see that what is the transaction we are entering into, or business we are doing, each transaction. In that transaction, what is the probability that we may face loss? That has to be, first we have to calculate whether it is 10 or 6 or 5 or 4 or 0, whatever it may be. This will be the probability. And if it happens, then what will be the related loss or impact in quantum? So we can say it is 4, it is 5, it is 5, or it is 0, or it is 1, whatever. We can see that. So when you multiply this probability with impact, then we get the final score, which is called, here it is 40, it is 30, it is 25, 0 and 0. So we can find out how risky or what would be our loss assessment for that particular transaction.
Sir, please repeat this one. Sir, please. 10, 4, 6, 5.
I am translating this percentage into a rating of 0 to 10. 0, 1, 2, 3, 4, 5, 6, 7, like 10. 10 is the highest losses. 0 is the least losses. Or probability, 0 means there is no probability that it will happen. 10 is the 100% chances that it is going to happen. So I am replacing those numbers up as percentage. And impact, as I told you, I am giving these numbers as the quantum of loss in the range of 0 to 1. So this is the probability, this is the impact. So according to this, probability means this might happen. 10 times it is going to happen. And if it happens, our loss will be 40% loss. So 10 into 40 becomes our score of 40%. So I can say that there is a chance of 40% loss in this transaction. Similarly, second one, 30, 25, 0, 0. Like this, we can give the score. These are the risk score. risk score. We can keep this risk score. For each transaction, we can assess that risk score. Or in other way, these are translated into a thing in risk management which is called a risk weight, which is already decided by Basel Committee as well as RBI as the regulator, and they have given and assigned the risk weight for each kind of loan and investment we are making in the financial world. Whatever you name it, what kind of loan you are giving, they have assessed that this risk weight is 40 or 30, 20. That means what? If the risk weight is 75%, that means there is a 75% risk in it and 25% no risk. Or we can say this is safe. Where risk weight is given as 75 or 75%, that means we have a risk of 75% where 25% is no risk. Suppose risk weight is given 100%, that means there is 100% risk available in the transaction. Risk weight is given as 20%, that means we have 20% risk. This is 20% risky and 80% safe. 0% risk weight. 0% means there is no risk at all. So this is how the risk weight is arrived, and risk weight is already given by the regulator. And risk weight is very, very important when we are going to calculate the capital. There is a formula where this risk weight has to be multiplied with loan and other factors to get the capital. That we'll discuss in our further classes. Is it clear?
Yes, sir.
Yeah.
Now we'll see what is the risk management framework in the bank. Every bank has got a framework, means how the risk management thing will be set up in a bank. Who will be working, who will be heading, like that, and how many departments will be there, who is going to take care of what. So this is what the basic thing. So basically we'll see that since bank is managed by the top management, so risk management is the major concern of the top management. It is the major, because they are managing the entire bank. Top management means basically we are talking about board of directors. Board of director, your CEO, chairman, or AD, and some of the GMs and directors of the bank, they comprise of board of director. So they will take care of the risk management framework in a bank. That means they will be taking care of the policy and guidelines which will be prepared by the bank to be followed by each and every staff and branches of the bank. That policy, etc., to be made by this top management only. They will, in the policy, they will design everything. They will set the different risk limits for each type of transaction we are doing. And each type of individual in the bank who are heading as a branch head in different scales, for them also different risk limits or sanction limits has to be set by this top management. They will also ensure that the bank must have the best risk-adjusted return, RAROC. Because we have to keep in the view the capital we have to maintain or capital we have to employ. Because capital is not a free thing. Maintaining capital is also costly. Because capital comes from two sources. One is either from the profit, or second is from the investors or the owners of the company. They will provide the capital. So it is the top management role to ensure the best risk-adjusted return, keeping in view the capital which is employed by them. So for all these things, To manage this risk in the bank, any financial organization, it requires a special skill. You need a special skill. It is not a simple skill that anybody just knowing about the banking, they can work in risk management department or they can be part of the top management's body. It requires a special skill which is more oriented towards the controlling aspect of risk. So you should be knowing or you should have the knowledge of special knowledge of controlling aspect of the risk in the business, for which every bank has a separate setup having specially skilled people in the risk management department. Okay, so these are the requirements. So now we'll see what is the hierarchy of this framework. How the framework, the special people have been selected and they have been hired and they have put in the department, and how this department, different hierarchy has been made in the risk management department of your bank in the head office, and what are their roles. Because certain times these questions are asked in the MCQ, so we should know. So basically the hierarchy of a risk management portfolio or risk management in a bank can be divided into 4 categories. The top place is board of director. Second place is risk management committee of the board. Third is the committee of senior level executives. And fourth one is the risk management department. So all are in the head office only. They are part of your head office setup. So these are the 4 setup. You should remember that. Now I will tell you what are the broad functions or role of these 4 levels. Because sometimes questions are asked on these levels and their functions. So you have to be careful to understand that. So board of directors are at the top management. So we can say the overall responsibility lies with the board of directors, because they will frame the policies framed by them only. They will look into system and procedure. They will issue the different guidelines which are to be issued, because we are working under the regulator RBI. So as per RBI's direction, all the policy, system and procedure guidelines will be changed. So those are to be framed by this board of directors. Also, they will be part of the final review of all the policy, as well as they will report to RBI as regulator or government how far we are achieving the risk management thing in the bank. So that is the job of board of directors. Now we'll see what is the job of the risk management committee of the board. Basically, they are responsible for the fact that since the overall responsibility of setting up the guidelines, system procedure guidelines, everything are with the board of directors, they will think this thing, this policy, what will be there, and it has to be setting the policy as a document. So it should be documented by risk management committee of the board. Means all the guidelines, policy, circular, everything, how this has to be framed, that setting is to be documented by the risk management committee board. Their job is to, after making this possible, they will say that they will ensure that the risk management procedure or process is being complied with the bank by each and every individual staff, as well as all the branches are conforming to the risk management policy. They will be also suggesting, or they will be taking care of periodical reviews of the policy. And they will suggest this to board of directors. Finally, they will approve. They will ensure that a robust system is there in the bank as far as the skill and talent of the people concerned, as well as technology concerned. We have a robust risk management system in the bank to take care of all the risk management models and policy. And they will be also responsible for the manpower of the risk management process in the bank, or proper manning of the process, what will be the requirement of technology as well as manpower. So that these are the job of risk management committee. Now, next one is committee of the senior level executive. Their main job is implementation part. Basically, first and two hierarchy, they will be doing all the things, but whatever the things are done, it has to be implemented. So implementation of all the things which are directed by this board of director and also have been directed by this management committee of board, they have prepared all those things together. Everything has to be implemented in the bank. So this committee of senior level executives' job is to ensure the implementation of all the things in a consistent manner so as to achieve the objective, business objective, our business goal. We are setting up all these things to achieve our business goal or objective. So it has to be implemented. So senior level executives committee's job is to ensure that it is implemented properly. And they will also help in reviewing the process. So time to time, there might be changes. So in the reviewing the risk management policy, they will also guide or direct or suggest the changes to be made in the policy to the risk management committee of the board. Next, higher authority. The last one is the risk management department. So it is at the lowest level of the head office. So basically, they will be in touch with the ground level staff and branches. So their job is to analyze. They will analyze everything. They will monitor. And they will report back to the higher authority. So, and since they are the ground people or they are in touch with the ground people, so they are also in the touch with the market. Since they get all the information from the branch level and the people, so they will also examine the market. What is the current market? How it is behaving? What is happening? And so if you know the current market, so you can also know what are the various possible changes that may require according to the prevailing market condition. And they will recommend those changes to the next higher authority. So next will report to the next, and finally to go to board of directors, and they will do the policy. So these are the, briefly I have outlined this thing. So question might come. If the question comes, which committee or which hierarchy of risk management portfolio of your bank ensures the implementation of risk management? So out of these four, which one the correct one? Implementation is done.
Committee of senior level
Committee
executive.
of the senior level.
Very good. So our answer will be third one. Who has got the overall responsibility?
Board of directors.
So board of directors. Who is in charge of monitoring the risk management?
Management department.
Very good. So such type of questions are expected. So you have to be You have to know what are the roles of these four. If the questions are asked, then easily you can take the correct answer. Such questions will come in. Okay. Now, the theoretical part is over, or the fundamental definition or knowing the risk management. Now you are entering into the proper subject of risk management. So, how the risk management is done? So, there are 5 steps of risk management. So, first is, you know, we have to identify the risk. Means, where is the risk? Where is the risk? First, we have to know where is the risk and what type of risk it is. What and where. Because each transaction, we are making each transaction. Every time a transaction is made, we have to find out where is the risk in this transaction and what type of risk it is. That is the first job. So we have to know different kinds of risk. Different kinds of risk. What are the different kinds of risk? We have to know how this is happening. Which transaction, what kind of risk is there? So first we have to identify that. If we can identify first, then we can measure that. So basically, risk identification means we have to know the risk and we also see that what is the probability here. What is the chance of risk happening? Then next is the measurement is about the impact. It means we will measure if risk is there, this is the risk which is present in this transaction, what will be the loss we may suffer? That is the impact. So identification, after identification, we have to measure the risk. Okay. Now, after this, identifying, measuring, then definitely these are done. These will be helping us to find out what is the amount of capital required. That is totally a separate thing we are coming. These are the 2 factors required, and we have to measure the capital and maintain that amount of capital for a particular transaction we are making. Okay. Now, apart from that, third step is called risk pricing. Risk pricing in the sense that, as you have understood, that there are higher risk, medium risk, or low risk will be there. Risk has been categorized, or we can give a number from 0 to 10. So higher risk means we know that it is higher loss or higher profit, but we have higher capital to be maintained. So medium risk means medium profit, medium loss, and medium amount of capital. Low risk means lower profit, low loss, and low capital. So always see, we take out of this profit thing. Now what remains? Higher loss and higher capital for high risk business or high risk transaction. Medium loss, medium capital for the medium risk business. Low risk, lower capital for low risk business. That means what? Here higher capital has to be maintained. So there is a cost involved and there might be higher loss. So for a higher risk type of loan, we have to charge more premium, or we can say the rate of interest we should charge to high risk type of loan will be always higher. And for lower, it is lower. So that charging of rate of interest for such loans is called the pricing. So pricing of the loan is decided on the risk factor in that transaction or type of loan. So your MCLR, how this MCLR, etc., are decided. They are decided taking into consideration various factors which will be added up to find out what should be your MCLR. So one of the factor is a risk factor. That has to be added. Okay, so that is risk pricing. Next is risk management is a continuous process which is going to happen in the bank. So the monitoring and control has to be done in a continuous basis by the risk management department. Okay, and fifth one is risk mitigation. Mitigation means to reduce the level of loss due to risk. How we can reduce the level of loss or impact of loss which is happening due to risk. Other than any other methods are available. So that is the risk mitigation process. If we can assess that this much will be lost, so we can arrange for something. Like every loan is given by the bank, we ask for collateral security. That collateral security is a mitigation process. Why we take collateral security? Because if loan is not paid by the borrower or borrower defaults, then we can easily go after his collateral security, which has been charged to the bank as security. We can go for court or SARFAESI. We can sell this security to adjust that loan. So that is a mitigation process. That means any kind of such other thing which is available where we can reduce the amount of loss, that is called risk mitigation process. Okay, so these are the different steps in risk management. Now we'll just see one by one.
Sir, please repeat this identification and measurement, sir.
I'll explain one by one again in detail.
Okay, sir. Okay.
Identification means you have to identify what is that risk, where it is. Right? Everybody has been provided with an ID card. Your bank provides an ID card. You have an Aadhaar card. Why these are provided? What does it signify? It signifies that you are Mr. X. Right? So identification means you have to look into the transaction you are doing in the bank. Where is the risk and what is that type of risk? That is identification. Then after identification, you have to know that due to the risk, that kind of risk we have identified, what loss it can bring us. That is the measurement. Is it clear now?
Yes, sir.
Okay.
Thank you.
So now, risk identification. This identification, I told you, it has to be done at the transaction level. First thing, transaction level means each type of transaction we make. Each deposit we receive, that is one transaction. Each loan disbursed, that is one transaction. Each investment made, that is a transaction. So at transaction level, each transaction level risk has to be identified. So basis this thing is that risk has to be identified at a transaction level, and what will be the impact on its portfolio level. Then we have to calculate the capital. These are the three things. Risk identification is we have to identify various risks which are associated with the risk taking of the person at the transaction level and examining its impact on the portfolio level and finding out what is the capital required for that to save that. That is the risk identification. Transaction level and portfolio level. Because transaction level means one loan is given. One loan is given. So we can say that 100 rupees loan is given and security taken is say 80. That means we can say that 20 is the risk here. Here we can say that 20% is the risk because out of 180 rupees is security available, 20 might be the risk. That is at transaction level. But when we take into the portfolio level, or this is the aggregate level. Aggregate level means suppose this is a vehicle loan which is given. So aggregate level at in your bank, what is the total amount of vehicle loan given as of now? So this is a single vehicle loan, 100 rupees is given. So total vehicle loan, if you see, it might be say 2 lakh amount. Okay, and when you see the 2 lakh amount, the aggregate level of collateral security you can see that it might be possible that 199, 8 and 80 might be the security available. So,
बाबू ऐसे लग रहा है और हो गई तैयारी जीके की
okay, aggregate level, we can find that at a transaction level, the risk might be more, or risk factor might be more, but when you come into the portfolio level, the risk will be reduced because there are huge amount of portfolio available for that type of loan. So when you consider at a transaction level, the risk factor might be say 40%. When you merge into the portfolio level, the risk might come down to 10% or 8%. Because that thing is called diversification of risk. We'll discuss that diversification in separate. So normally at a transaction level, the risk might look, say, very bigger amount, but when you take into account that total vehicle loan or total housing loan taken into consideration, then it will come down to a lower level because there might be more good loans than bad loans when you take into portfolio level. So according to that, we have to see the impact at the portfolio level only, not at the transaction level. Because transaction level, it will be look into the more, but portfolio level, it might be less. And according to that, on that basis, the capital has to be calculated. So this is how the risk identification has been. Okay. Now, I will show you some example, give one example, simple example where one loan is given and this loan is funded by one deposit. Simple case, every loan we give, it should come from the deposit. So one loan has been disbursed by one of your branches and another branch has received same amount deposit. So it is funded, there is no problem. And how any change in any type of transaction on this existing loan and existing deposit tomorrow or day after will bring in a risk. And how this risk will be there, we have to identify what is that risk and how it is going to impact. Okay, so now I'll give examples. Let us see a simple situation. So a branch of yours has given a loan of 1 crore rupees for a period of 3 years at MCLR plus 4%, say it is 12%. So your MCLR is 8%. And the loan is to be repaid in, it is not quarterly, you can say equal, say EMI. Now consider this EMI. It is to be paid by EMI with a 1 year moratorium period. Is it clear? There is nothing complex in it. A loan has been given by your branch. Now, when the loan is given by the branch, means asset side, this 1 crore rupees has been gone up. Now, each loan is given, your head office should always match this loan with an equal amount of liability or deposit. So, at the end of the day, the number of loans and the amount of loan given by your different branches, that is with the head office. They will see that this much of loan is given. So we have to fund this loan. whether deposit is available with us to fund that. If deposit is available with us, then we can fund it. Or if deposit is not available, then bank has to, your treasury department has to go to outside to borrow that money to fund that. So this is a everyday job, because our bank gives loan out of the liability we receive. So if that is sufficient deposit which are available still, then you can easily give a loan, or you can make an investment. Here we are starting with a loan. The branch has given a loan. Then that means your head office should look for a deposit or liability. If deposit is available, then they will match this loan with that deposit. If it is not there, then they have to borrow that money from the market or from RBI so that it will be matched. So every day this job has to be done. Because if deposit is not available, that means you are not having the fund. So you have to arrange for the fund. So this is called funding risk. If the fund is not available, there is a funding risk. So deposit is not available for funding this loan. So we have to borrow from the market. So borrowing from the market will be the costlier than the deposit rate we are paying. So that's why our profitability might be reduced. So that's why it is called a funding risk. Okay, when fund is not available to match with the loan which is given or asset which is created, then that will be a funding risk. Okay. Now, suppose fortunately, this 1 crore rupees which is given by your Delhi branch, suppose this is disbursed by your Delhi branch, and the same day your head office finds that one of your branch in Chennai, they have canvassed a deposit of same amount of 1 crore for a 1-year period, where the rate of interest payable is 6.25%. That means the funding risk has been managed. There is no fund requirement now because Chennai branch has secured a deposit of 1 crore rupees. Clear? Now, situation 1. Everything going on fine. What will be the next change in the asset or liability? Without any, so everything goes. The loan is going on well, he is paying monthly installment, deposit is there. So what might be the possible nearest change that may happen in future?
Interest change.
Okay, fine. Okay, interest change might happen. Let us keep that for next. So what is the next change? I'll discuss that interest change later. What is the next change? Pardon?
Repayment.
Repayment. Mismatch. Here loan is for 3 years, deposit for 1 year.
Very good. See, repayment is done. I told that repayment is monthly, it is done equally. So there is no failure in repayment. So next change is that deposit has been canvassed for a period of 1 year, whereas this loan is given for 3 years. So this is a long-term asset which has been funded by short-term liability. So ideal condition is when the asset time is equal to the liability time, that will yield the maximum return. But here there is a mismatch. So asset is for 3 years, liability is for 1 year. That means what? After 1 year period or before 1 year period also, the depositor may come to take the payment of the deposit. Either you will ask for premature payment, or on the maturity of the deposit, he will take that. He will take the money. Means he will not renew the deposit. So what risk we are expecting here?
Mismatch, gap or mismatch?
No, it is not gap or mismatch. What risk we are expecting here?
Sir, funding risk.
Liquidity.
Very good. Very good. Funding or liquidity risk. Funding or liquidity risk. Because funding is, see, up to 1 year this is funded. after 1 year, when the liability is taken, again funding risk is coming or liquidity risk is coming. Same thing. Liquidity means we do not have the deposit. So we have to look for a deposit or we have to borrow from the market. So what is funding risk? Funding risk is the risk of unanticipated withdrawal of the liability or non-renewal of the liabilities, which are the source of funding of any kind of loan. And liquidity risk is when you don't have any fund in your pocket. So if the deposit is gone, means you are having a liquidity problem. Clear? So this is called the funding risk. Okay. Second situation. Suppose after the deposit matures, after this 1 year period, suppose the funding is done by a new deposit or this deposit is renewed. Either this possible. Funding is done by you. So funding risk is taken care of. But at that point of time, we are not certain that whether this rate of interest will be 6.25 or different from 6.25. Say the rate of interest which bank is going to pay for is 6%. In such cases, whether there will be any risk?
Yes, sir.
How?
Base
Interest rate risk.
How?
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 No, sir. No, sir. No risk.
Interest
Income will become less.
For
Sir,
bank,
we are
no risk.
giving the
Net getting
interest.
back to
Sir, we
the
are giving the
deposit.
interest of 6.2.
6.25 earlier you are giving, now you are giving 6, means there is no risk. Na?
Yes, sir.
Risk is
Because
when we are, risk
giving
will
6.1.
happen. Yes, if it is more than 6.25,
6.25.
like if it is 6.3 or 6.5, then only there will be a risk. So
Yes, sir.
if the deposit is renewed at a lesser rate of interest, then there will be no risk. But if the interest rate goes to 6.50 at that point in time, then there is a risk. Okay. So that means if due to this fact, this transaction, if there is a reduction of net interest income due to increase of the rate of interest in the liability side or decrease of rate of interest in the asset side, in such cases, that risk is called gap or mismatch risk. So what is this gap or mismatch risk? This gap or mismatch risk is the creation of gap between asset and liabilities, where when some long-term assets are funded by short-term liabilities, and after the maturity or renewal of the liabilities, the rate of interest either in the asset side or liability side have changed inadversely, which affected adversely by reducing our net interest income. So that risk is called gap and mismatch risk. Okay. Now third thing, we are coming to third situation. Suppose he was supposed to pay all the EMI. Now the borrower has defaulted in payment of one EMI. One EMI has been defaulted by him. That means the EMI has not paid. So in such case, 4 types of risks will come. First is default risk, because he has defaulted in paying the installment. Second is, can you please mute your mic, please? I'm requesting you 1,000 times. When your answer is given, please mute your mics. It is a simple procedure of clicking on button only. It is not a different difficult task. So second is, since it is pertaining to loan, so it is a loan risk, or we can call that it is a credit risk, because it is happening in the loan side, so it is a credit risk. So default in the loan. So default risk might be in a loan, default might be in investment also. So it is a default risk in the loan portfolio. It is a credit risk because it happens in the loan. And third is this EMI of, say he was supposed to pay 1 lakh of EMI. So this EMI should have been there in the bank at the particular time, but it has not come. So 1 lakh of liquidity is not there in the bank. So we have also liquidity risk. Because if 1 lakh would have been come, then that liquidity can be used by the bank. And fourth is that since it was decided that every quarter or every month he has to pay the installment on a certain date. So for each installment, a certain time is fixed. So whenever the installment does not come to the bank in time, there is also a time risk. So for a default of one installment, 4 types of risks will arise. So we have identified here 4 types of risk due to one default of installment. Now we'll see that.
So what is time risk? So last one, time risk. It is not coming on time.
Yeah, your EMI or quarterly installment you decide for the borrower. You set a date for that or not. You give a date in the agreement. That date is given or not.
Yes,
on
sir.
5th of every month or 10th of every month or 15th of every month or 20th of every month. You set a date, na? So that date is the time. At time he should have paid the installment. Since he has not paid, so it is also a time risk. So when it is asked what is a time risk, you always remember that when an installment which was supposed to be paid on time, it has not been paid. Okay.
Yes, sir.
Now, another risk is that this asset side interest is floating because it is linked to MCLR, which may change in 15 days, 10 days. MCLR might go up or might come down. Whereas this FD has got a fixed rate of interest. It will not change for that period. So risk will happen within this period of 1 year. Suppose MCLR goes down, then there will be a risk. If the MCLR goes up, then there is no risk because we'll earn more. But if the MCLR comes down to say 7.75, our interest rate will come down by 11.75. So there will be a less margin because from 11.75 you have to pay 6.25 depositor. So your margin becomes 5.5, whereas earlier it was 5.75. So it has reduced by 0.25%. So that is a risk. So this risk is called basis risk. This is called basis risk. Due to change of interest rates, only change of interest rates on one side on different magnitude, which may reduce your net interest income, that is called basis risk. Okay? Now,
so what is the difference between basis risk and gap risk?
So gap, okay, always people confuse between this gap and basis risk. Basis risk, always remember that one side change might happen in different magnitude, which will reduce your NII. Okay. Now, in case of gap or mismatch risk, always the condition is that whenever the condition is that a long-term loan is funded by a short-term liability or deposit, and there is a change of rate of interest in either liability or asset on renewal of the deposit. Okay, on renewal of the deposit, there is a change or the MCLR changes in this one. So at that point of time, we can call that there is a gap which is created or there is a mismatch which is created. But here, it is not about that, not at the maturity of the deposit or that. It might happen at any point of time. And basically, whenever such thing happens, we link it to basis risk. Because this has happened due to the change in the basis point of the rate of interest. Normally, when the asset side changes happen, we link it to the basic risk. And whenever this liability side happens, we always say that it's a gap or mismatches. Okay. And you should not be confused with the term interest rate risk. Because interest rate risk is not a term which is normally used for deposit and loan. Interest rate risk is always used for investments, or we can call this is a market risk, not a credit risk. So credit risk, interest rate risk is always called basis risk. So you will find the basis risk in the loan or credit risk is there. When it is linked to the investment or market, it is called interest rate risk. Both are same, only name is difference. Okay. Now, there is another type risk which might happen. Here, the EMI was coming to the bank. Every month, say 5th of every month, 1 lakh of EMI is coming to the bank. So this is the liquidity we are receiving. Now, since 1 lakh has come, so definitely bank will not keep it in idle. Bank will either give a loan or make an investment out of this 1 lakh. Each time the installment comes, bank will definitely utilize that liquidity for a fresh loan or fresh investment so that earning of the bank will be there. Now, just hypothetical condition, this loan, we are earning 12% on this. So if the 1 lakh is coming to the bank, it is ideal for the bank that this 1 lakh should be invested in a loan or investment where we can also earn 12% or more. That is the ideal condition or good for the bank. If we are not earning that 12%, suppose this 1 lakh is given for a loan where you are earning only 10%. That means this new loan will be earning less than the existing loan. That means this amount of 1 lakh has been reinvested in a loan which is giving a return less than the existing one. So that's why we call it reinvestment risk. Is it clear? Because sometimes question comes on this reinvestment list.
Sir, once more, sir, please.
Pardon?
Sir, please once more,
Repeat
sir.
one, sir.
Repeat once more.
Repeat one, sir.
The EMI is coming every month or not?
Yes, sir.
Yes, sir.
1 lakh you are receiving for this. Okay. So when you receive this 1 lakh in the bank, do you keep this 1 lakh idle or you want to give a fresh loan or make an investment?
New investment.
New investment or loan has to be given. So always any fund we are in this coming to the bank as a new deposit or the loan installments, they are class inflows. They are inflows, and these inflows are not to be kept idle. They have to be invested with a new loan or new investment to earn something. Okay. Now in this situation, this 1 lakh has come from this loan which was earning 12% rate of interest. Okay. Now this loan or investment you are making, suppose this loan is given, 1 lakh is given to a person, a loan, which will earn say 11% or 10%. which is lower than this 12%. That means you have reinvested this in 1 lakh at a lower rate of interest of earning than the existing one. So that's why this is called a reinvestment risk.
Yes, sir. Good.
Clear?
Yes, sir.
Yes, sir.
So if
Yes,
the
sir.
loan is given at a rate of 12.5%, then the reinvestment risk is not there. Clear?
Yes,
So
sir.
our approach should be that always we should earn at least equal to that cash flow which has come from or more than that. If
Or
it is
more.
not, then it is called a reinvestment risk. So reinvestment risk is the uncertainty with regard to the interest rate at which future cash flows could be reinvested. This is a future cash flow which can be reinvested. When these are reinvested at a lesser rate, then there is a reinvestment risk. Okay. Now, another risk which might come at any point of time. This depositor may come to you for premature closure of the deposit. Similarly, this borrower can come to you saying that prepayment of the loan. They will say that I want to close the loan. I don't want to continue for 3 years. I have a lot of money, or I have gone to another bank who is charging less than interest to you. So you take your money and I want to close this. So at any point of time, this prepayment of the asset or premature payment of the liability might happen. So if such thing happens, normally premature payment happens means we know that there is a liquidity risk will be there. Funding risk will be there if the loan is still there, and definitely deposit is going. Apart from this liquidity funding risk, another risk is coming to picture for this type of prepayment of the loan or premature payment of deposit. That is called embedded option risk. Remember this name because sometimes question asks, what is embedded option risk? So embedded option risk is that due to adverse movement of interest rate in the market, it may result in prepayment of the loan or even premature payment or premature withdrawal of the deposit. So due to that, our profit will be definitely impacted adversely. So there will be a risk, and that risk is called embedded option risk. Okay. So risk identification we have completed. Next class we'll come to the risk measurement. That is a very, so please be prepared for this because from the next class some numericals will be there. We'll start the numericals as and step by step when I am going to discuss the things, some numericals will be there. So we'll be discussing about sensitivity, we'll be discussing about BPV, we'll be discussing about the duration, lot of things will be there. So be prepared to read this chapter till now I have covered so that it will be easier to you. If possible, you can also read the future chapters so that it will be easier to understand while you take the class, and always be in the class with a calculator. Simple calculator will be so that we'll do some numericals. It will be easier for you to. Okay. Any question is there? You can ask. So there will be one confusion for you, I know, about the gap or mismatch risk and basis risk. Always there is a confusion. It is very well explained in the Macmillan book. You just read once, it will be clear. If it is not clear, in the next class, again, I will explain. Because that is the one confusion always happens for each and every one. Even when I studied the first time that one, I was also confused. What is the difference? I find there is no difference at all, as if they are equal. But if you read that, everything is given clearly in the book. Maybe my language was not clear to you, so I could not explain that way. But if you read that, it will be understood clearly. Other than that, every risk is very clear, except the gap or mismatch risk and basis risk. You read that in the book, and if still confusion is there, next class I will again give explanation with an example. Okay, any other question?
Sir. No, sir, thank you.
Thank you, sir.
Thank you. Have a good day. Okay, we'll see you in the next class.
So shall we get the PPT, sir?
PPT, I told you yesterday, na? PPT will be shared after the entire module is completed, not before that.
Right.
Because only one PPT I am using. So I cannot share it now. Okay, because other classes. So normally I share the PPT after the class is done. Because if I share the PPT now, what will happen? You will stop reading the book. You will look into the PPT first, which is not desirable. First, you should study the book. And PPTs are for reference afterwards. So once you complete the book, it is better to refer the PPT.
Right.
Okay, it is revised. That is the best process. Otherwise, what happens? Normally, human psychology is that when PPT is received from the faculty, they will look into the PPT, they will forget the book. So if you forget the book, there is a chance that your marks will be less. So I will not advise that one. So I will be giving the PPT after the module is complete. Risk management will be completed. I will share the risk management.
Right.
PPT. Then balance sheet management also completed. I will share the balance sheet. Okay. Okay. See you then. And if there is no other question, we'll end up. Okay.
Sir, regarding questions, questions in risk management, theoretical will come more, sir, and problematic numerical will come more, sir, in exam.
That is a very risky question you are telling. We do not know how these are coming. So because see, now the set of questions are there. To whom how much percentage of theory and how much numerical comes, there is no set of rules. So it is now programmed in such a way that normally it is about 40-60 should be coming. 40 numerical, 60 should be theoretical. But we have seen that sometimes it is the reverse way. 60 numerical, 40 theoretical. So you cannot predict how much is numerical. It is like a one-day match you are playing. Virat Kohli scores century someday and gets out in 0 or 1 or 2 also. So you never know what will happen to you. So better that you should be prepared with all your armors.
Okay, sir. Okay, sir.
Do not depend on only numerical or theoretical. You have to prepare fully so that when the ball is coming, you can hit it for 4. So it will pass. Okay. So do not depend on that.